Welcome back to 7-Minute Options. Today I want to take a quick look at two earnings plays that I'm thinking about putting on. Today is June 15th, and there aren't too many good earnings coming up, and even the ones that are shown here on Tasty, I went to look at them, and many of them don't have weekly options or don't have options expiring in the right schedule relative to the earnings announcement, or they don't have the IV crush, etc. So I didn't find any really good ones. I found two that I think might be okay. And the first one is Oracle. If I look at Oracle, Oracle is announcing their earnings today after the market closed. So right now it's today's June 15th. There's two here, two options, one expiring 3 days from today, one expiring in 10 days. I like to go at least a week to 10 days away. So this is the expiration I'm going to be targeting here, the 10-day expiration, mainly because after the binary event of the earnings announcement, you want to give the underlying a few days, usually 4 or 5 days, to revert to the mean. Because quite often there's going to be a big jump up or a big jump down. It'll blow past your short strikes, and if then your option expires, then you could be expiring in a losing position. Whereas if you give it 10 days, quite often after a big move on the first day or right after the earnings announcement, in the following 3, 4, 5 days, it'll revert back to the mean and quite often move back above your short strikes and allows you to close it for a small gain. So I'm going to be looking at this one here. If I look at the volatility, this one here that's expiring 10 days from now, the June 25th expiration, right now it has an IV of 43. I expect that to collapse to the low 30s. Like 31% is the IV of options that are trading 1 to 2 months out. So that is significant. That's an IV reduction of about 30 to 40%. So that's definitely something we can look at. The option pricing is not terribly juicy. But I think it's enough to put something on and hope for the best. So if I look at the actual one that's here, so the one that's expiring 3 days away, the expected move is plus or minus 3.5 points. So that's pretty much the expected move from the earnings announcement, right? If the earnings are happening today, give or take, maybe 3 points, let's say. So if the expected move from earnings is 3 points, then right now we are at 81. So in theory, if I was very brave, I would go 78. And 81 minus 3 is 78, 81 plus 3 is 84. However, this option is going to be open for 9 days after the earnings announcement, right? The earnings are happening today, so this thing is expiring 10 days from now. So I want to give myself more of a chance to win. This is actually not bad, collecting $2 in credit. The only thing I don't like here is the upside risk, which is uncapped. Generally speaking, I really don't like to have uncapped risk to the upside, because then things can run away from you and you could be rolling and chasing for months and months in a position that may never come back. So I'm okay with taking risk on the downside, but I'm not yet comfortable enough to do risk on the upside. Now, if my account would be like over 100,000 and I would have portfolio margin, I would be doing this all day long, but I'm not there yet. My account is not even at 20,000. I think it's just around 19,000, give or take. So it's going to take me a few years to get up to 100,000. And by few, I mean like much more than a few. But anyway, getting back to the earnings trade. So I'm going to move this down to the 77 just to give myself, that's a $4.7 cushion. And it's outside the expected move, so I feel okay about that one. And this one here, if I look at this one, I want to be in one where, okay, there's a lot of people here. Okay, that's giving me 4 points to the, 85. Okay, $3.20 move to the upside. Maybe that's not enough. But if I cap it to, let's say, with the 86, I can collect $81 in credit. My only risk here, my maximum loss on the upside is really $1 minus the 81 cents. So if it goes really high and it's not coming back, I stand to lose about 20 cents right now, right? It's $1 minus the 80 cents, but I can also roll up this short strike once at expiration and collect another 5.10 in credit. So there's a good chance I can, if this flies to the upside and doesn't come back in 10 days, that I can close this for a scratch, like basically a $5 loss or something, or almost next to nothing. So this kind of caps my limit to the upside. And on the downside, if it does go below 77 and doesn't recover, then this is a naked position. I can roll this indefinitely. This one here, I cannot roll indefinitely, but this one I can. I actually feel pretty good about this one. Just as out of curiosity, what happens if I don't even have this? So if I don't only have the naked put, I get 57, which is not a whole lot, and I pick up a lot of positive deltas at 2.77. If I put on that 85.86, I pick up another 20-30 cents in credit. It's still highly positive, of course, yeah, because this has a much greater effect on the delta and on the overall position than this, because this is undefined. And so yeah, I get 7 thetas for $1,200. I'm hoping to take this off sometime in the next 2, 3, 4 days. So I'm expecting a relatively big move tomorrow, like a 3-4 point move, and then hopefully it'll revert back to the mean. But let's see if I can get 80 credit for this. Again, there's not a lot of volume in this option here on my short strike. On the 77, there's only 100 people in there, but it's only 3 cents wide. So maybe I can get that filled. And of course, now I gotta sit there. Nobody jumped at it at 80. Okay, I'll leave it on at 79 and see if somebody takes it. So I'm going to leave that one on. The Adobe one is the other one that I found. So Adobe is interesting here. They are announcing on June 17th. And you can see we have one expiring on June 18th. And so you can see that 19 plus or minus 19 point move is pretty much entirely earnings, or just about almost all of its earnings. So let's just look at plus or minus 19 points for the expected move from the earnings announcement. So I have this other option here expiring 10 days away. And this is what I kind of set up here without looking too much into it. Again, it's a $500 product. I'm not going to take undefined risk in here because a 20, 30, 40 move past my short strikes, I mean, that could destroy my profits for the entire year. So there's no way I'm going into this undefined. But I can take a $5 risk. So this is actually pretty good. Check this out. $5 risk to the downside, $5 risk to the upside. So I pick up $200 in credit. The maximum loss is the balance, which is the 300. You can see it there. And the only buying power is the maximum loss, which is 302. I pick up a whopping 8 theta. And as long as the earnings, remember, yeah, so we had 20-point earnings move. So 525, that is exactly 20 points. And 540, 565 would be 20 points. So I'm giving myself an extra $5 cushion. Remember, I can't roll these because these are spreads, but if I do get challenged on one of them, or it gets blows past my short strike, then I'm going to take the spread on the losing side and roll it toward the other one, and basically turn it into a strangle of sorts, right? Maybe not a strangle, maybe just a very tight iron condor, but that would also allow me to pick up another 20, 30 bucks in credit and help my losses that way. But again, like, this is the earnings play. I'm outside the expected move here. I'm just at the edge of the expected move there, but a little bit outside the expected earnings move. This allows me to pick up $200 in credit. If I get filled, I will try to buy that back for $100. I got filled on Adobe, fantastic. So I'm going to take that Adobe position. Where is it? Adobe, there we are. And I'm going to put the GTC order in right now. So I got 202. That's awesome. Okay, $4 more than I expected. And I'm going to put the position there for, let's say 98 cents. Actually make it 99. There you go. 99 would give me half of my 202 minus 97. Yeah, half of my 202 minus the $4. Again, that's just my personal preference. I like someone else to pay for my $4 transaction cost, but I mean, that's a personal thing. Anyway, so yeah, I'm going to put that GTC 0.97. Shouldn't have clicked in the middle. GTC order, so I hope to buy that back for 97 cents. And yeah, even though the IV rank is low, don't let that discourage you. What really matters is the actual IV. And there is a fair amount of crush. I mean, the options chain has an IV of 38, and I expect this to drop down to a 30% level. That's where the Adobe options are trading about a month out. So that's significant enough. Plus, the time premium is going to come out of there pretty quick because it's only 10 days to expiration. And if we're in between the strikes, all of that's going to go to zero. So hopefully this will, if the earnings report has a small jump, or if it reverts back to the mean, and I'm in between my strikes, I hope to close this in the next 4, maybe 5 days and collect that $100. So let's see how that goes. Again, now Oracle is trading for 82 cents, but nobody's buying it for my 79. What's going on? Yeah, I think the challenge there with the Oracle one is just there aren't enough people in this one here, in the 77 strike. And I could go down to 76 strike, but then I'm not picking up a whole lot of money. That one has 2,000 people. That should be easy to fill. 2 cents wide. Do I want to do that? Let's see. Go back to Oracle. Replace this order. You know what? Like, here I am trying to pick up 20, 30 bucks. No, I'm just going to cancel this. I changed my mind on this Oracle trade. I don't like it that much. Just to pick up another 30, 40 bucks, and then who knows, I could be holding that bag in case Oracle has bad earnings or whatever. There just isn't enough premium in there. So yeah, so the only one I'm opening is Adobe. Hoping to collect $100 there. There's really aren't any whole lot of other earnings. If you guys see anything out there, just let me know. Drop a comment or something. I don't know. But yeah, that's it. Thanks.